A wise veteran market commentator named Ray DeVoe once said that more money was lost chasing yield than at the point of a gun. Some bond investors are starting to agree with him. I'm Jack Otter, editor of BARRON'S.com. I'm here with Micah Nero, who writes our income investing blog. This week in the magazine, you tackle the junk bond world. First of all, junk bonds have been quite popular for a while. Why is that?
They've been a high-yielding investment in a low-yielding world. The junk bond market got crushed like everything else in the financial crisis, lost about 26% in 2008, but since then they've returned, on average, 20% a year as the Fed's policies have pushed people into the highest-yielding investments around. Now, the problem is that that sort of reaches a diminishing point at some point, and right now, junk bonds on average only yield 5.2% versus a historic average around 9%.
And so do you think that you're getting enough return in return for the risk of going into these junk-rated companies?
That's the big question right now in the junk market. The case for junk bonds is still, hey, it's the best yielding thing out there, even at only 5.2%. And the credit risk, which is sort of the main risk you get with junk bonds, the risk of a company defaulting, is still pretty low. The junk bond default rate is only about 1.7% now, and it's only expected to go up to about 2.5% by the end of the year, and that's still well below its historic average. And so people look at it and they get a sense of security, saying, "Hey, these companies aren't about to default all that soon."
Plus, they think the bigger risk right now is not that companies are going to default, but that interest rates will go up, and so at least they get a little extra yield for taking that risk.
Correct. However, that is now becoming an issue in the junk bond market, which it rarely has been before, interest rate risk. Because yields, all-in yields, are so low, junk bonds are now a little bit more vulnerable to interest rate moves in addition to being vulnerable to credit risk. And in writing the column that I wrote this past week, a lot of fund managers, and particularly unconstrained bond fund managers who are able to buy anything they want, are starting to turn sour on the junk bond market because the amount of risks starting to pile up are there. People don't necessarily see anything bad happening imminently in terms of a big wave of defaults, but when you've got such low yields, 5.2% on average now, combined with the potential for a rise in interest rates and any sort of market shock that sends
black swan.
Exactly, that sends people into safer havens, junk bonds are suddenly very vulnerable. And the question is, does 5.2% pay you enough to take these risks?
We should point out that Jeffrey Gundlach is one of the people who's saying he's a little cautious with high yield right now, and he's not a guy who in recent years you've been paid for betting against.
He's done very well. Some of the other people I talked to in the story, Goldman Sachs, TCW, some very big names in the income investing world are starting to say, hey, this is starting to get a little too rich for our liking and we're going to cut down on our junk bonds.
Good to know. Thanks, Mike.
Mm-hmm.